Today, you will learn a fourth way to derive buy signals under the Dow theory for the 21st century. To recap, we had the typical buy signal, which is lows, secondary reaction, breakout. Then we had the highs of the last completed secondary reaction, which was our fallback entry. Then we had the so-called bull market definition. And now we have a fourth one, which is a little bit more sophisticated, but is really highly important to get early back in the market when there is a sudden reversal. Because market timing is not infallible. Sometimes you get whipsaws, you get reversals, but the trick is to get back in early enough so that you are once again in gear with the prevailing trend. So let's explain. Look. We have a bullish trend, the market is going up, as you can see, higher highs, higher lows, higher highs, higher lows on the three indexes, the S&P, the Dow Industrials, and the transportation, and then we get the typical sell signal. So we have a secondary reaction here against the bullish trend, and then we have 2 or more days rally. Remember, this is not a secondary reaction. The secondary reaction against the bull market is this. And then you get the 2 or more days rally, which completes the setup for a sell signal. And then there is the breakdown. So the lows of the secondary reaction lows get violated, and always confirmation in this kind of signal only by at least one of these other two indexes. So once we get confirmation, we got the sell signal. This is nothing new. We already know this. This is the typical plain vanilla sell signal under the Dow theory. What's interesting is what happens after this classical signal. Let's imagine suddenly the market starts to go up and then it breaks up above the rally highs. These are the rally highs. So we had the secondary reaction. We had that at least 2 days rally. Then we had the final breakdown, and it was the typical sell. But let's imagine this happens from time to time. Then there is a huge rally, and we break above the rally highs, these 2 or more days rally highs. And this happens on both the S&P 500, the Dow Industrials, and also the Dow. It is the very same thing. Here we have, this is the secondary reaction. This is the rally that set up for the previous sell signal. And then these rally highs here are broken out by a new rally. If this happens in the three indexes, because we require triple confirmation, then we get a new buy signal, which means that we are back into the market. And this buy signal is really very important, I repeat, because it allows you to get back into the markets early. Because if you had to wait for the normal sequence of rally, pullback, breakout, then maybe your next entry would be here. Because remember, it's good to remember a little bit, to recap, that the buy signal number 1, the typical one, if we didn't have this, would mean that we have a rally, secondary reaction, new rally. So it would be an entry price at a much higher level. So this entry, which means the breakout of the previous rally, is a vital buy signal that allows you to rebuy when you have been stopped out earlier.